The Federal Reserve System, often referred to as the Fed, is the central banking system of the United States. It was established in 1913 with the enactment of the Federal Reserve Act to provide the country with a more stable and flexible monetary and financial system. The Fed's primary objectives include promoting maximum employment, stable prices, and moderate long-term interest rates, commonly known as the dual mandate. Here's how the Federal Reserve System manages monetary policy in the U.S. Setting interest rates. One of the primary tools used by the Fed to manage monetary policy is the setting of the federal funds rate. The federal funds rate is the interest rate at which banks lend reserves to each other overnight. By adjusting the federal funds rate, the Fed can influence borrowing and lending rates throughout the economy, which in turn affects consumer spending, investment, and overall economic activity. Open market operations. The Fed conducts open market operations, buying and selling government securities, such as treasury bonds and bills, on the open market to influence the money supply and interest rates. When the Fed buys securities, it injects money into the financial system, lowering interest rates and stimulating economic activity. Conversely, when the Fed sells securities, it removes money from the system, raising interest rates and slowing down economic growth. Reserve requirements. The Fed also sets reserve requirements, which are the minimum amount of funds that banks must hold in reserve against certain deposits. By adjusting reserve requirements, the Fed can influence the amount of money that banks can lend out, thereby affecting the money supply and overall economic activity. Discount rate. The Fed sets the discount rate, which is the interest rate at which banks can borrow funds directly from the Federal Reserve's discount window. Changes in the discount rate can signal the Fed's stance on monetary policy and influence banks' borrowing and lending behavior. Forward guidance and communication. The Fed uses forward guidance and communication to provide guidance to financial markets and the public about its future monetary policy intentions. This can include statements about the future path of interest rates, economic projections, and the Fed's assessment of current economic conditions. Clear communication helps shape market expectations and can influence borrowing and spending decisions. Quantitative easing. During periods of economic downturn or financial crisis, the Fed may implement unconventional monetary policy measures such as quantitative easing, QE. QE involves the purchase of large quantities of financial assets, such as government bonds and mortgage-backed securities, to inject liquidity into the financial system and lower long-term interest rates. Overall, the Federal Reserve System plays a critical role in managing monetary policy in the United States, using a variety of tools and mechanisms to achieve its objectives of promoting price stability, maximum employment, and moderate long-term interest rates. The Fed's actions have far-reaching effects on the economy, financial markets, and the well-being of households and businesses across the country.